everybody, it's Craig Moser. It is the 13th day of February. Man, it just flies, doesn't it? So I wanted to get together with you a little bit and go over some charts, as I always do, and give you a little bit of a look at what's happening in the markets from a technical perspective. Maybe it'll help. Anyhow, if you have questions or anything, just give us a call at 336-448-1086. We're happy to help. And let me just dig in here. All right. So here we are with, I just happen to have gold up here for no particular reason, but we'll look at gold first. I was looking at them before I turned this on. Here's a 1-year look at gold. Now gold, from its top, which had a pretty big bounce up here right around a year ago, dropped about 20-some%, but right here is the trend. If you can sort of see where the market in these up and down red and green things right here goes, we're trying to get as many of these points to touch as we can, and you're seeing that trend was fairly negative, rebounded back up. But if you look at a 1-year number, it's kind of funny, it's flat. It says down 1.08, but somebody could argue that that's right here, and then it would be a flat return. So gold really hasn't done anything other than it dropped about 20-some% and then recovered back. Okay, so somebody might ask, how come that it recovered back? Sometimes gold is fear about the US dollar. I'll do that one just as an example. Here's a way to look at the US dollar. This is not the dollar, but Invesco has a dollar index, and it shows the pricing of the US dollar. So the dollar was running up a year ago, and then it dropped pretty good. And so, you know, you can kind of see that it's down from its market high back at here, September of last year. So, you know, that's the US dollar. If we look, for example, at the bond market has gone down a great deal. Here's its trend, and right now, it's difficult to say whether it's going to break its trend. Most of what we hear from the Fed is that they're going to have 2 more interest rate hikes. They want to have us in the 5.5 range for the Fed funds rate. So we're not there yet, but we're getting there. And bond prices, not yields, prices have dropped. You know, pretty much October was the low so far. So if you bought bonds in October, probably did pretty well. If you had bought bonds recently, what you're seeing is a little bit higher prices, but not substantially so. You're still able on the corporate side to get in the 5s, but not the mid 5s, just 5.1, somewhere like that. Anyway, if he raises rates 2 more times, we'll see a Fed funds rate pretty much in the 5 range, and we should be able to do pretty good on corporates. You know, not trying to give you bond prices, but we just placed some treasuries in there that last a whopping 6 months, and they were in the upper end of the 4% range. So you can kind of get a feel for what you're able to get in yield currently. But this is the bond aggregate, which takes in all of the bonds, and you can see that it has made a low. So maybe we have seen the worst of the drop in bonds, and it may be something to pay attention to at this point. Stock markets. No, my word. So it's interesting. Everybody's getting encouraged here. Let's just start with what I have. Here's the emerging markets index. Let me do a 2-year window so you can really see what I did. So 2 years ago, that was June of 2021. And you can see this market has declined substantially. And that's sort of the trend line right here, maybe a little lower. I can pull that down a little bit so you can kind of see that that's pretty much what we're seeing the most from a trend standpoint. So emerging markets, Russia, India, China, you can kind of see where that would be a problem. You know, Russia's escalating a war, Ukraine, China's threatening us a little bit and doing some things that people are uncomfortable with. So, you know, this is going to be interesting to watch how this stuff pans out. But the emerging markets have really not given us any positive chart pattern so far, down 23 to 26, 27% since June of last year. easiest way to say it. If we do it over 1 year, it's not quite as easy to see, but still, I mean, it's a declining market. It's not an increasing market. We just had a pretty good bounce from a bottom. When we look at Europe, so Europe is, Canada, Australia, France, England, Germany, and a host of others, but that's pretty much what we see for the vast majority of them. And if I go on a 2-year number, you can see from November of 2021 down, that market was down 25%. That's pretty small, and has bounced back up. Now, take that into account. Europe and other countries other than the United States, which we would call the developed countries, have had a fairly good recovery from its market bottom right here, which was October of last year. Interesting to watch this area. So if something breaks out any further in the Russia thing, who's at risk? These guys are, but so far the market doesn't say that they believe that there's going to be any escalation down there past where it is in Ukraine. Although we're sending tanks, so is Germany. Obviously that makes people nervous. All right, the S&P 500 index, which is widely called the stock market. Now, it's not the market for me because it's so weighted to tech, but everybody seems to use it, so that's why I use it for you. And you can see a very, very clear line right there. Here, here, here. Every time it sells off and gets a bounce, that bounce so far had been lower than the previous bounce, and then right here. So what that tells you is perhaps, key word, this may be a breakout. This may be a breakout from its low back here. And again, that was early October of last year was the bottom. So is that a breakout? We shall see. Certainly hope so. I'd like to see the markets move up, but from this date right here, which was 1/3/2022 to today, that index is still down, I don't know, 14%, something like that. Depends on how you measure. 14% would be a good number. So as we're looking at this, just understand, the world's not great, but it's better than it was if we were having this conversation in October. So just understand that my belief, it's a belief only, you can take it for what it's worth, is that we will continue to see this type of volatility into this year. Doesn't mean that the markets are going to crash it or anything unless there's something unexpected that happens. A war would do that. We saw all these earthquakes and everything in Turkey. 33,000 was the number I saw this morning. Pretty rough. I guess that happens all the time, folks. I mean, there's always something going on in this planet, but the world turns and we just keep marching on. I guess that's how you have to approach it. Anyhow, I wanted to let you see what I'm seeing. There's nothing else that I can really get to. I don't want to do a bunch of individual stocks. I like to do charts, but right now the market doesn't seem to be too discouraged. Money has been moving back into it, fairly strong. And right here was sort of that last bottom, which was right before Christmas. And so we've had a fairly modest rally since there. So I'll just have to keep an eye on it. Do I believe that we're out of the woods? I don't. I think we'll probably see some of this recession hit. I'm seeing more unemployment numbers. I'm afraid the CPI numbers are going to come out and say that inflation's starting to creep back up, because I haven't seen prices go down at the markets, meaning the food markets. I haven't really seen prices go down, although I'm not seeing them go up in the gas markets. So just paying attention, wanted to be in touch with you. If you have questions, of course, call us at 336-448-1086. You can reach me or any of our other advisors. We have 3 other people here, and be happy to chat with you. And with that, I'll let you go for your day and make it a good rest of your February.